11-14 हो गए।
सर इन्फॉर्मेशन नहीं आई तो मैं कुछ नहीं कर पाऊंगा।
वहां से आती है
बिल्कुल।
अच्छा अच्छा
हेडक्वार्टर से कनेक्टेड रहते हैं ना।
हाँ
वो लोग लिंक करते हैं फिर वाटाकारा को साउथ में वहां से कुछ अच्छा होता है जो टीवी पे आता है वहां से यहाँ से हेडक्वार्टर से यूट्यूब पे ले जाता है। Start.
Good morning, students. Today we are going to studying emerging issues in accounting, human resource accounting, and forensic accounting. Human resource accounting is the process of measuring the value of a company's employees and the costs you see associated with them. It's an extension of standard accounting principles that helps identify and report investments in human resources. Suppose you see any visitor comes to your company and he asks you what is your pay bill. Pay bill means you see every month you see what are the total salaries. So everybody you see must know. Due challenges in measuring HR's impact due to the intangible nature of HR initiatives, managers often face the challenges like resource allocation, difficulty in deciding which HR programs to invest in, how much to invest, and whether a program adds measurable value. Sporadic, you see, commitment, lack of measurable outcomes leads to inconsistent resource allocation for HR programs. Demand for measurement, accountability pressures have led to the development of methods for measuring HR's contribution to organizational profit. Key development influencing HR accountability are triple bottom line, best places to work, macro level HR studies, human capital management, accountability demands from management, HR technology, HR in crisis management. Triple bottom line, traditionally business success was measured solely by profit. The triple bottom line concept expands this to include environmental and social impacts. It focuses on measuring how business operations affect society, including costs that are not borne directly by the business, such as pollution. This is often categorized as, you see, people, planet, and prosperity. Best places to work. Since the 1990s, organizations have strived to be recognized as employers of choice to attract and retain, you see, talent. If you see, if the company finds that you see this officer is very, you see, good for the company, they will retain him. You see, they will increase his salary also. While such human resource programs can lower turnover and recruiting costs, they require a significant investment and their true value is difficult to measure without a proper evaluation process. Macro level HR studies have tried to establish a direct link between HR investments and profitability, but results have been, you see, inconclusive. These studies suggest that while profitable companies tend to invest in HR, the relationship between HR initiatives and Increased profitability is not always clear. Human capital management, as economies you see shifted from agriculture and manufacturing to you see services, human capital became a focal you see point. You see, earlier you will remember in our country, you see, we were fully dependent. You see, our country was agriculture-based country. You see, and our agriculture used to depend on rains. You see, but now you see so many industries and service sector have developed. Early attempts to quantify human capital through HR accounting evolved into benchmarking marking techniques that compare key metrics like compliance, compensation, and retention. Accountability demands from management. In resource competitive environments, management demands data to justify HR investments. This is particularly challenging for HR departments as many of their outcomes, such as employees' engagement and satisfaction, are intangible and difficult to measure. HR technology advancements in technology have automated many HR functions, such as you see payroll, record keeping, and recruitment processes. While this has streamlined operations, it has also you see reduced HR's role in some organizations, shifting responsibilities to finance or information technology departments. However, human resource technology has enabled the collection and analysis of large amounts of data, helping HR measure its impact more effectively. HR in crisis management, HR plays a you see crucial role in navigating organizational crisis. HR practices impact long-term outcomes, making effective you see management vital during times of uncertainty. Approaches to human resource you see accountability. Human resource management by objectives, MBO. In this approach, HR departments develop specific, measurable objectives based on management's expectations. These objectives often include targets for turnover, absenteeism, job satisfaction, productivity, cost, and expenses reduction. The success of these objectives is assessed based on their contribution to the overall performance of the organization. Number two is employee attitude surveys. Employee attitude surveys are used to measure the relationship between employee attitudes and organizational performance. Research has shown that companies with higher profits and often conduct these surveys. An advanced version of this is the Human Resource Index, used by organizations like IBM and Xerox to track employees' attitudes, satisfaction, and commitment. HR reputation, the effectiveness of HR can be evaluated based on feedback from organizational stakeholders. Key factors include open communication channels, transparent performance standards, fair remuneration and rewards, employee participation in decision making. While feedback is important, there is little evidence, you see, linking stakeholder satisfaction directly to organizational performance. HR auditing, HR audits systematically evaluate the effectiveness of HR processes. Common audit areas include recruitment and selection, how they have done the recruitment, you see. Then about, you see, training and development, then compensation. Employee relations HR audits provide valuable data to assess whether HR practices are functioning effectively but have limited direct connections to organizational performance. HR case studies. This approach involves, creating case studies based on HR programs or interventions. Data from these programs, combined with feedback from participants, help evaluate their effectiveness. While useful, this method captures only one time information and may not reflect ongoing performance. Human resource cost, monitoring. Human resource cost monitoring involves comparing actual HR, human resource costs such as salary and benefits with internal or external benchmarks. A common measure is the HR cost per employee, helping organizations track and manage, HR expenses. Next is key indicators. Key indicators are quantitative measures that reflect HR's contribution to the organization, including accident rate, absenteeism, turnover. These indicators are often linked to organizational outcomes like productivity and quality. HR effectiveness index. The HR effectiveness index combines various HR metrics to create a composite score that reflects the department's impact on organizational performance. An example is General Electric's Employee Relation Index, which tracks metrics like absenteeism and terminations to assess HR's contributions. HR profit centers. In some organizations, HR department operates as profit centers, charging other departments for services like training, recruitment, and compensation, management. This approach helps evaluate HR's financial contribution, but it may face resistance as user departments may prefer external service, providers. Then next is competitive benchmarking. Benchmarking involves comparing key HR indicators, that is absenteeism, turnover, against industry leaders. While this can help, improve HR processes, the availability of relevant benchmarking data for HR function is often, limited. Human resource accounting as a management decision tool. Investment decision. Human resource accounting provides valuable insights that can influence investment decisions, especially for external investors and creators. The presence of human resource accounting data in financial statements can change how managers assess performance, potentially altering investment judgments. However, while financial HR information plays a significant role in corporate investors decisions, non-financial HR information has a lesser impact. Human resource planning, HRP. Human resource planning involves the acquisition, utilization, improvement, and retention of human resources. HRA helps, managers by providing a cost matrix for recruitment processes, aiding in personal management, turnover decisions, and performance evaluations. However, the challenge lies in accurately assigning monetary values to HR variables like employees turnover. Performance management systems measures and manages employee performance based on organizational goals. HRA supports performance management systems by offering insights into recruitment, hiring, training, and workforce integration costs. It can also be used to estimate replacement costs and guide training and development investments. Training and development. HRA helps organizations assess the value and return on investment, ROI, of training and development programs by measuring training costs. HRA aids management in selecting the most effective training methods to enhance employee performance. Compensation management. Compensation management involves creating fair and transparent salary structures HRA provides insights that help design equitable compensation systems by linking salaries to employees, value and contribution to the organization. HRA measurement models, cost-based methods, replacement cost approach, opportunity cost method, standard cost method. These are the four methods. Cost-based methods, HRA cost-based models focus on calculating the investment an organization makes in its employees. These costs are capitalized and amortized over the useful life of the employee, and the remaining cost is treated as an asset in the balance sheet. This method includes acquisition costs, costs incurred in recruitment, selection, hiring, and placement of employees, training and development costs, expenses aimed at enhancing employee skills and productivity. That can be done by training, welfare costs, costs related to creating a positive work, environment for employees, good ambience, other costs, any additional costs incurred in managing, employees. Replacement, cost approach. This method calculates the cost of replacing an organization's existing human resources. It is an alternative to the historical cost method and focuses on estimating the value of employees based on their replacement cost. Opportunity cost method. In this approach, divisions within an organization bid for scarce employees. The bid price reflects the perceived value of the employee, with the successful bid determining the employee's value. Standard cost method. This method assigns a standard cost to employee recruitment, training, and development. The total standard cost for all employees is used to estimate the organization's human resource value. Value-based models. Lev and Schwartz present value model. Flamholtz stochastic rewards valuation model. Morse model. Hermansen model. These are four models. Lev and Schwartz present value model. This model calculates the present value of an employee's future earnings by discounting their expected future income. While it provides a financial estimate of human resource value, it has limitations such as not accounting for employee turnover and changes in job roles. Flamholtz stochastic rewards valuation model. This model improves on Lev and Schwartz by considering the probability of employees moving between roles or leaving the organization before retirement. It calculates the expected value of an employee's contribution. Morse model. The Morse model estimates the present value of net benefits an organization derives from its employees. It calculates the difference between the gross value of employee services and the cost of future payments to employees. Hermansen model. This model assesses human resource value based on the firm's actual profit compared to a normal rate of return. Any excess profit is attributed to the value of human resources. Now, forensic accounting. What is forensic accounting? Forensic accounting is a multidisciplinary field that combines accounting, auditing, computer forensic, investigation, and law. It focuses on gathering evidence that can be used in legal proceedings. Forensic accounting is used to uncover fraud that regular audits may miss, especially when there is, collusion among managers, executives, or auditors. Occupational fraud. Occupational fraud occurs when employees, managers, promoters, or owners commit fraudulent acts that harm the organization. In a corporate setting, forensic accounting plays a crucial role in identifying and investigating such fraud. Types of frauds, you see, asset misappropriation. This is the most common type of fraud where assets are stolen or misused, though it generally leads to smaller losses. Financial statement fraud, less common but more severe. This type of fraud involves manipulating financial reports, resulting in much, you see, larger financial damage. See, you are, doing window dressing or manipulating financial statements. You see, many times you see customers do just to avail banking facilities, more banking facilities just to avail that they will do that. And asset misappropriation, this is the most common type of fraud where assets are stolen. You see, if any asset is stolen or misused, so that is asset misappropriation. Fraud triangle. The fraud triangle is a concept used in forensic auditing to identify factors that lead to fraud within an organization. It highlights three main factors that are often present when fraud occurs: incentive and pressure, opportunities, rationalization, and you see attitude. Incentive and pressure. This refers to the need or pressure that drives individuals to commit fraud. Now, you see, customer is needing, you see, the reviewed limits very urgently. He wants to use. Customer submitted a proposal to enhance the credit facilities with a bank. He was already having the credit facilities, but he has requested to enhance the limits. Now there is a procedure, bank's procedure is there. And you see, but he is after the bank, he is in very much hurry. He wants immediately the new limits should be, you see, released to him. Now, while doing so, sometimes you see, when analysis of the balance sheets will be done, by you see if any mistake is left and you see money is released to him and tomorrow the account becomes, you see, NPA. So staff officer should not be under pressure. You see, in one go you ask the customer to submit. You see, your proposal has come, your application has come for review of limits. So you please kindly provide us the following last 3 years audited balance sheet and other, you see, certificates, copy of the certificates, copy of the letters. So then after that, you see, customer will, you see, comply, customer will submit. And then you prepare the proposal as per the, you see, rules of the bank. Don't come under pressure. If you will come under pressure, you will do some mistake. Next is incentives such as stock options. You see, company gives to the employees stock options, shares they give, which are tied to a company's performance, can also lead to manipulation of results to maintain or increase the value of these, you see, options. Key factors that contribute to, you see, pressure. Threats to the financial stability of the company, pressure from investors, you see, banks or other stakeholders to meet expectations, you see. Now sales are not increasing. You see, bank has released the funds because you will, you see, do the projected sales. So bank is after you, following with you that every month bank is following that why sales are not increasing. Then pressure from the investors, those who invested money, they also want that company should do good. Threats to the personal wealth of top management due to, you see, poor performance. Now, if there is poor performance, the personal wealth of the top management will also, you see, be used in recovery. So they are having threats like that. The need to maintain or improve debt ratings to raise finance. Pressure on employees from management to achieve, you see, unrealistic targets. Yes, this is the latest, you know. Now they will give target, you see, you open so many accounts Daily you open, you see so many accounts. So sometimes it is possible, sometimes it will not be possible. You are contacting the customers, but if they are not, you see, opening the accounts, they are not taking interest, you see, nothing can be done. You can only, you see, do from your side, you see, best. So key factors that contribute to pressure are threats to the financial stability of the company, pressure from investors, banks, or other stakeholders to meet expectations, threats to the personal wealth of the top management due to poor performance. Now the performance of the company is poor, so top management, their wealth, they are, you see, worried about their wealth. The need to maintain or improve debt ratings to raise finance, pressure on employees from management to achieve, you see, unrealistic targets. You see, you have said within, you see, you open today so many accounts. If it is not possible, you see, nothing can be, you see, done. Next is opportunity. Opportunity arises when there are, you see, weaknesses in internal controls or company structure, allowing fraud to happen. While it is generally assumed that people are honest, certain circumstances can create, you see, openings of fraud. The organization's control environment, including its internal controls and IT systems, also plays a crucial role in limiting opportunities for fraud. Weak internal examples of opportunities that lead to fraud, weak internal controls or lack of supervision, non-segregation of duties, you see, where one person has control over multiple aspects of a process. The nature of the industry or the complexity of the business structure, a dominant position in the market that may, you see, allow the company to engage in inappropriate transactions, poor oversight by audit committee, non-executive directors, and the board, irrationalization and attitude. Rationalization involves, you see, how individuals justify their fraudulent behavior. This factor is shaped by personal values, ethical, you see, standards, and the organizational culture. If the company takes a lenient stance on fraud or is lax in enforcing internal controls, employees may feel it's acceptable to commit fraud. You see, the forensic auditor's role is to identify if these biases and justifications, you see, exist within the organization, as they are red flags for potential fraud. Common rationalizations for fraud: belief that the fraud is temporary and will be, you see, corrected later, management's indifference towards fraud and weak monitoring of internal controls, a feeling that the individual deserves more recognition or compensation than what the company provides, a culture where unethical behavior is rewarded or ignored. Some major corporate frauds in our country. Satyam Computer Services, see, long back it occurred. Amount involved was $1 billion, more than $1 billion. Modus operandi was the company's founder, Ramalinga Raju, inflated the revenue and cash balances on the books. He has inflated the revenue and, you see, cash balances on the books. You see, these figures were inflated, increased. False billing for non-existent services was used to show inflated profits. You see, false bills were, you see, generated, false billing for non-existent services. The services which were not there, which were not existent. You see, for them, those services, you see, was used to show inflated profits. and fictitious bank balances were reported. You see, bank balances, reporting of bank balances were also, you see, fictitious. This allowed the company to mislead investors about its financial health. So investors, you see, did not come to know about the financial health. Next is, you see, Kingfisher Airlines, Malia. It is $1.3 billion, approximately 9,000 crores. What was modus operandi? Vijay Malia's Kingfisher Airlines defaulted, you see, on loans taken by misrepresenting the financial health of the company. So the data which he submitted to the bank was, you see, false. That was not the actual data. And then after that, they defaulted in repaying the loans. Funds meant for operations were allegedly diverted to other business. Now, what happened in Malia's, you see, business? Funds meant for operations. Those funds were, you see, diverted to other businesses. Money from this business was, which was financed by the bank, was taken out and it was invested in another business. Mismanagement. You see, this is what is mismanagement. Mismanagement including, you see, unpaid employee salaries. They did not pay salaries to the employees and excessive personal expenses. And their personal expenses were too much, Malia and family. Further, you see, worsened the clients, worsened the airline's condition. Despite mounting losses, Malia continued operations and the airline collapsed in 2012. Yes. He should have closed the operations. You see, when he came to know the actual position of the, you see, airlines, he should have closed, but he did not close. The airline collapsed in 2012. Next fraud is, you see, Jet Airways. Now, in Malia's case, you see, he borrowed from many banks. So that money is outstanding with those banks. Those banks are following up. Now, next is, you see, 25,000 crore rupees fraud. $3 billion fraud. Modus operandi. What was the modus operandi? The airlines was involved in overstating expenses by inflating commissions paid to the related party in Dubai. By inflating, you see, commissions paid to a related, you see, party in Dubai, resulting in an, you see, under-reporting of profits. So they under-reported the profits, number one. The company inflated the commissions. Funds were also diverted through loans and fake invoices were, you see, created, you see. Now, they did not pay the bank loan, you see. This led to defaults in payment to lenders and vendors, you see. The airline was involved in overstating expenses by inflating commissions paid to a related party in Dubai, resulting in an under, you see, reporting of profits. Funds were also, you see, diverted through loans and fake invoices were, you see, created. This led to defaults in payment to lenders and vendors, you see. They did not pay to lenders, they did not pay to vendors. Fraud amount of Bhushan Steel, 50,000 crore. You see, $6.1 billion, $6.1 billion. Now, what was modus operandi? The company misused funds borrowed from banks by routing them to over 200 shell companies. Capital expenditures were, that were never, incurred, were reported. Capital expenditures were reported, but which were not incurred, and the funds were diverted to personal gain. And the first one, funds were, diverted. Some, directed to the funds for personal gain. Funds were, taken. So, company misused funds borrowed from banks, and and made the investments in 200 shell companies by banks by routing them to over 200 shell companies. The money went to 200 shell companies. Capital expenditures that were never incurred were reported. The expenditures which were in nature of capital, it never incurred, but it was reported, and the funds were diverted for personal gain. And those, that amount was taken for personal gain. Now, next is PNB fraud, Punjab National Bank fraud. 16,000 crore, $2 billion. Modus operandi: two diamond merchants, Nirav Modi and Mehul Choksi, defrauded Punjab National Bank by fraudulently obtaining letters of credit (LCs) without any underlying transactions. The LCs were not recorded in the bank system, enabling them to bypass checks and audits. So LCs were issued by the bank, but they were not recorded in the system. And Nirav Modi and Mehul Choksi, their representatives took the LC from the bank, but those LCs entries was not done. So if entries were not done, then follow-up would not be done. Follow-up would not be done. Next is, company's name is the Infrastructure Leasing and Financial Services. The Infrastructure Leasing and Financial Services. The Infrastructure Leasing and Financial Services amount was 91,000 crores. $12 billion. Modus operandi: the Infrastructure Leasing and Financial Services management indulge in multiple fraudulent practices such as evergreening loans, over-invoicing, diverting funds to related entities, and misreporting profits. So there were 3-4 things. There were misreporting in profits. They were diverting funds to related entities. They were transferring funds there. Over-invoicing, they did over-invoicing. Then such type of things, company was doing. Now, application of forensic, accounting. Forensic, accountants help in bankruptcy cases by working with both debtors and creditors. Friends, this Punjab National Bank fraud where Nirav Modi and Mehul Choksi were involved, one more problem was there. In that bank, the person who was issuing LC, he was in that desk for the last many years. He never used to take any leave also. So he used to, he knew that, some garbage he is doing. But bank should have, rotated his job. Banks, it is a mistake of the bank also. Now, application of forensic accounting. What are the applications? Now, bankruptcy, insolvency, and reorganization. Forensic accountants help in bankruptcy cases by working with both debtors and creditors. Forensic accountants help in bankruptcy cases by working with both debtors and creditors. They perform business valuations, assist in managing financial affairs, identify pre-bankruptcy transactions and search for hidden assets, help creditors recover more funds by locating hidden or misrepresentative assets. Computer forensic analysis. In today's digital world, most financial transactions occur electronically. Forensic accountants usually recover and preserve electronic evidence from computers and digital platforms, understand how and where electronic information is stored, use their skills to assess and secure this information for litigation support. Next is economic, damage calculations. When disputes arise between parties, forensic accountants help calculate damages by estimating, lost profits or earnings due to actions taken by another party, reviewing and refuting damage claims made by the opposing party, assisting in negotiations to settle damage claims without litigation. Forensic accountants play a significant role in cases involving inheritance, wills, and Hindu undivided family, cases where they trace assets and income, marital dissolution, divorce, where they evaluate the earnings and expenses of each party to determine, alimony and child support. Financial statements, financial statement misrepresentation. When financial statements are, misstated, forensic accountants investigate issues flagged by auditors, such as, overstatements, omissions, or improper accounting, determine how these affect the financial reports, uncover it if there was any intent or scheme behind the misrepresentation. Fraud prevention, detection, and response. Forensic accountants specialize in designing systems to prevent fraud, investigating existing frauds, implementing improved controls to prevent future fraudulent activities. Fraud origin and account cycles, sales and collections receipt cycle. This cycle tracks the process of selling goods or services and collecting payment from customers. It starts with the creation of sales orders and continues through the invoicing, payment collection, and account reconciliation. Common frauds in this cycle include, fake sales, overbilling, or manipulation of cash receipts, controls like segregation of duties, regular reconciliation, and monitoring customer payments can help, prevent fraud. Purchase and, payments, disbursement cycle. This cycle involves the procurement of goods and services and the subsequent payment to suppliers. It starts with, placing orders, receiving goods, and processing invoices, and ends with the disbursement of payment. Fraud in this cycle often occurs through inflated invoices, kickbacks, or paying for goods that were never received. Strong internal controls such as verifying purchases and supporting documentation and conducting regular audits are essential to prevent, fraudulent disbursements and ensure financial integrity. Personal and payroll cycle. The personal and payroll cycle deals with, employee compensation, including, wages, salaries, benefits, and tax withholdings. It starts with the recording employee work hours and ends with, you see, payroll processing and payment. Common frauds include ghost employees, falsified work hours, or unauthorized salary increases. Now, common frauds include ghost employees, you see, employees are not there, falsified, you see, work hours, or unauthorized salary increases. To prevent fraud, companies must implement strong payroll controls, such as segregating payroll duties, maintaining accurate employee records, and performing, you see, regular audits of the payroll system. Inventory and warehousing, you see, cycle. This cycle manages the tracking, storage, and movement of inventory, including raw materials, work in progress, and finished goods. So the cycle manages the tracking, storage, and movement of inventory, including raw material, work in progress, and finished goods. It includes receiving goods, recording inventory levels, and issuing inventory for production or sales. Fraud in this cycle, you see, may involve theft, misstatement of inventory levels, or unauthorized use of company resources. Regular physical inventory counts, effective inventory tracking systems, and security measures help prevent fraud and ensures accurate, you see, reporting of assets. Monthly reconciliations and reporting. This cycle ensures that all financial transactions are accurately recorded and reconciled at the end of each month. It involves reconciling bank statements, you see, adjusting entries, and preparing financial statements, you see, profit and loss account, balance sheet. Frauds in this cycle can, you see, occur through intentional misstatements, delayed recording of expenses, or manipulation, you see, of accounts. Timely and accurate reconciliation of accounts and independent review of financial statements are essential, you see, controls to detect and, you see, prevent fraudulent activities. Regular reporting, you see, ensures transparency and compliance with accounting, you see, standards, you see. We have seen, you see, big frauds, you see. We saw the fraud of, you see, this Choksi. What they used to do, they were, you see, banking with this Punjab National Bank, and this Punjab National Bank officer, you see, he helped Choksis in the fraud. What that officer used to do, he used to send, you see, letter of credits to foreign countries' banks, but here he was not passing, you see, bookkeeping he was not doing, he was not entering in the records. One Swift machine is there for messaging. So he used to do messages he used to send with that Swift machine. And he alone was doing for a lot of time, he kept on doing. But when the new person came, you see, he said, he did not, you see, agree. So he immediately reported the matter to the management. Then the bank, you see, came to know about it. So there are many small frauds also which happen in the bank. For example, you see, bank is you see giving loans on post office securities. Say, for example, national savings certificates are there. So what bank does, you see, the customer pledges the NSCs to the bank. So bank has to transfer those NSCs in bank's name. Now, bank has to send those NSCs to the, you see, post office, and their post office will make a note in their records that customer has taken loan from State Bank of India on these NSCs. So we have not to pay the NSCs unless and until, you see, loan is cleared, or if at all payment is to be done, you see, payment will be done to the bank. They make on the face of, you see, NSC also, they will, you see, put their stamp. These NSCs are pledged to State Bank of India. Now, for doing this work, if the bank, you see, gives these things to the customer only, bank says, you see, bank officer says that to the customer, you go to post office and, you see, bring this hourly. He prepares the letter. That letter he gives to the, you see, person who is taking loan. Now, if that person, you see, does not go to post office, he does it himself, and he comes back, and you see, he gives the NSC to the officer. Now, later on, you see, he obtains the payment from the post office. He makes duplicate NSCs and he obtains the payment, because in NSC's record that loan matter is not recorded, you see, by the post office authorities. So what bank should have done? Bank should have sent their representative. This is a very small, you see, example, very small example. Bank should have sent their representative to the post office for being the needful. Similarly, if you are giving loan on LIC policy, you see the LIC, you see, pay of the LIC only, you give the papers to him only. So he does not go to the LIC, he does the things himself and he obtains loan. And later on, he, you see, tells to LIC that I have lost the policy, and he obtains the payment from there. So there are many, you see, things which, you see, one has to take care, and then these frauds one can, you see, save from losing, you see, money. So now we will, you see, study in a, you see, the fraud tree we will study, you see. In the fraud tree, you see, fraud tree classification, the beginning of the fraud, you see, may have come from within the company or from outside the company. Internal frauds are those that are done by company workers or owners, whereas external frauds are those that are conducted by individuals who are not employees or owners of the company. The graphic that lists the majority of the possible instances of asset theft is commonly referred to as fraud tree. This is due to the fact that different ways in which frauds might take place are represented by branches of the trees, you see. According to taxonomy of the fraud tree, asset misappropriation can be further broken down into cash misappropriation, inventory misappropriation, and all other types of asset misappropriation. So on the top is, you see, asset, then there are two parts, cash and inventory and all other asset. Then cash, there are two parts, loss and skimming. Then, and third part is fraudulent disbursements, you see. Then loss is further of cash on hand from the deposit others. Then skimming is again, you see, broken in three parts. You see, sales unrecorded, understate, you see, receivables, write-off schemes, lapping schemes, unconcealed, then refunds and others. Then under inventory, you see inventory and all other asset misuse, larceny. Then under larceny, asset requisitions and transfers, false sales and shipping, purchasing and receiving, you see, unconcealed larceny. Then under fraudulent disbursement, you see there are 5, you see, points: billing schemes, payroll schemes, expense reimbursement schemes, check tampering, registered disbursements. Then under, you see, billing schemes, shell company is there, non-accomplice vendor is there, then personal purchase is there. Then under fraudulent disbursement, next is payroll schemes, ghost employees, commission schemes, workers, you see, compensation, falsified wages. Then next is, you see, under fraudulent disbursement, expense reimbursement scheme, mischaracterized, you see, expenses, overstated, you see, expenses, fictitious expenses, multiple, you see, reimbursements, you see. Then next is, you see, under fraudulent disbursements, check tampering, you see, playing with the check, you see, forced maker, forced endorsement, altered pay's name altered, you see, concealed checks, authorized maker, you see, amount is also changed. Then fraudulent, you see, disbursement, last is, you see, registered disbursements, false voids, false refunds. The most prevalent, you see, form of theft, which can take many different forms, involves the misappropriation of cash. Fraud is the intentional use of deception by an individuals, you see, associations with a company, whether they are in the capacity of employees, owners, vendors, customers, or anyone else related to or unrelated to the business, in order to appropriate money, services, or any asset that results in a financial loss for the company. Fraud can be committed by individuals in any capacity with the company. Next is, you see, tools for fraud detection. You see, number 1 is chance detection, new technology based, you see, that is divided into 2: fraud detection, tip received, you see, then technology based, you see, strategic method, then people focused, transaction, you see, focused, then people focused, bad guy list, then behavioral analysis, then transaction focused, inductive analysis, deductive analysis. Under inductive analysis, there digital analysis. Then under deductive analysis, strategic fraud detection is there. Then tip received. Tip received is, you see, hotline based, fortuitous tip. Then computerized traditional methods, you see, discovery sampling. Then financial, you see, statement analysis. So most financial transactions today are authorized electronically. Forensic computing is the act of locating. Methods of fraud detection are, you see, fraud detection use 2 methods: supervised and unsupervised. Supervised method, this method detects fraud using past fraud dynamics. This strategy uses earlier data and knowledge. Labeled information includes, legitimate and fraudulent transactions. Models are trained to distinguish real from fraudulent transactions using, prior data. These models assume past frauds will continue into the future. Next is unsupervised, method. Data mining based unsupervised algorithms identify outliers, suspicion scoring systems detect changes in behavior and conserving, analyzing and preserving digital, evidence in a court acceptable manner. This requires various tools and software. So Hegix based on, Nopix creates forensic, sound hard disk and partition images, Then ultra blood forensic, writer blocker, etc. So students, we are closing this, session. Thank you very much.